Imagine standing at the edge of a rocket launch pad. The countdown hits zero, and instead of smoke and fire, what ignites is a quiet, powerful surge that reshapes the future. That's exactly where silver is today, on the verge of takeoff. And I want to talk to you about why there is one date, one moment you simply should not miss. There are moments in the market when the data becomes so clear, the signals so aligned, that ignoring them feels almost irresponsible. And right now, silver is sending one of the most compelling signals I've seen in years. We are approaching a point where demand is accelerating at a pace the supply side simply cannot match. And when that happens in any asset class, the repricing tends to be sudden, sharp, and entirely unforgiving to those who waited too long. That's why the call to buy silver before this date isn't fear-based, it is fact-based. For years, silver has quietly sat undervalued relative to its own historical patterns, but today, the dynamics surrounding it are dramatically different. We have never seen this level of industrial dependence at the same time we've seen supply tightening. Silver is not just a monetary metal anymore, it is becoming a critical input to the technologies shaping our future. Solar energy, electric vehicles, AI-powered devices, and advanced computing infrastructures rely on silver's unmatched conductivity. This isn't optional demand, it's structural demand. Meanwhile, the supply side tells a very different story, and a problematic one, for anyone who thinks the market can simply produce more whenever prices rise. Mining output has been strained for years, with grades declining and new discoveries slowing to a crawl. Recycling contributes, but not nearly enough to offset what industry is consuming. And the deficit we're seeing is not a short-term imbalance, it's a multi-year shortfall that's widening. When you look at the numbers, it becomes obvious the market is already in a structural squeeze, and the world just hasn't woken up to it yet. What happens when technology demand collides with scarcity? You get nonlinear price action. That's what makes silver different this time. We're not talking about a cyclical rebound, we're talking about a fundamental shift driven by innovation, electrification, and the global race toward cleaner energy. Every solar panel installed anywhere in the world adds pressure to silver demand. Every EV charging station, every battery innovation, every leap in AI chips amplifies that pressure. This is a commodity becoming indispensable at the exact same moment its availability is becoming constrained. Layer on top of that the monetary dynamics, and the picture sharpens even more. A weakening dollar environment, rising geopolitical uncertainty, and the possibility of rate cuts all create powerful tailwinds for real assets. Investors are beginning to migrate toward stores of value, with silver-backed ETFs seeing consistent inflows. And these inflows matter more than most people realize because they pull physical silver off the market, locking it away in long-term holdings that reduce available circulating supply even further. This is why there is urgency. This is why timing matters. The market is approaching an inflection point, and once demand breaks past a certain threshold, the price won't rise gradually, it will gap. That's how commodity markets behave when they enter structural deficits. They don't respond politely, they reprice violently. So the question becomes, do you position before that moment or after it? The opportunity here is not just about profit, it's about foresight. It's about recognizing that the technologies defining the next decade depend on a metal most investors still underestimate. It's about understanding that scarcity isn't coming, it's already here. And it's about knowing that markets reward those who act when the evidence is clear, not when the headlines finally catch up. If you step back and connect the dots: innovation trends, supply constraints, monetary conditions, investor flows, you see an asset sitting on the edge of a dramatic move. And history shows that when these forces converge, hesitation is the most expensive decision of all. Silver is offering that rare moment where the fundamentals and the timing are aligned. The window is still open, but it won't stay open for long. There are inflection points in markets when an asset stops behaving like a commodity and starts behaving like a catalyst. Silver is approaching that phase in 2025, and the signals are becoming too strong to ignore. The convergence of technology, energy transformation, macro shifts, and structural supply constraints is creating one of the most asymmetric setups we've seen in over a decade. That is why the message is urgent. Buying before this date could be the difference between capturing the surge or watching it unfold from the sidelines. The first catalyst is technological. Silver has transitioned from being a traditional precious metal to becoming a foundational input for next-generation systems. Solar photovoltaics alone are accelerating at a pace that even optimistic forecasts failed to anticipate. Nations are pushing aggressive renewable targets, and solar adoption is scaling exponentially rather than linearly. Every panel installed globally increases silver consumption, and that demand is non-negotiable. There is no cheaper, more efficient substitute for silver's conductivity. This single sector is creating persistent pressure on global stockpiles, but solar is only one component of the story. Electric vehicles, battery technologies, 5G communication networks, and the surge in high-performance computing connected to AI all require silver. Every advancement in electronics shrinks margins elsewhere, but expands the need for ultra-efficient conductivity. This creates a future where silver demand is not just rising, it is accelerating at a compounding rate. And when a commodity becomes indispensable to the technological architecture of the future, its price inevitably rebalances to reflect that new reality. On the other side of the equation is supply, or rather, the lack of it. Mining output is not scaling to meet these rising demands, ore grades are dropping, exploration is lagging, and many existing mines are approaching depletion phases. More importantly, new mining projects cannot ramp fast enough to offset the shortfalls already appearing. Recycling helps, but only marginally. What the market is facing is a structural deficit, not a temporary imbalance. And the deeper that deficit becomes, the more severe the eventual price adjustment will be. Then we must consider the macro environment. The global financial landscape in 2025 is shifting toward conditions that historically favor undervalued hard assets. Interest rate expectations, currency volatility, and geopolitical tensions all push capital toward stores of value. Gold often captures headlines, but silver historically outperforms gold during major upward cycles because it is smaller, thinner, and far more sensitive to capital inflows. Even modest investment interest can send silver sharply higher when supply is already constrained. Investment vehicles themselves add another layer of pressure. Silver-backed ETF continue to absorb physical metal and remove it from circulating supply. These flows matter because they lock silver away in long-term holdings, reducing availability for industrial users who are already competing for resources. When financial demand intersects with industrial necessity, markets don't adjust gently, they snap. This is why the deadline matters. Markets move slowly until suddenly they don't. The forces building behind silver are not theoretical, they are measurable, visible, and accelerating. But markets often ignore these slow, building shifts until the final tipping point. Once that threshold is crossed, silver won't rise in small increments. It will reprice rapidly and aggressively, as it has in every historical cycle where demand overwhelmed supply. The window that exists now is defined by calm before the acceleration, a period where fundamental value diverges from current pricing. That gap is closing, and when it closes fully, the surge that follows will catch most investors by surprise. Acting before that moment is not about speculation. It is about understanding where the future is heading and positioning intelligently before the world catches up. If history teaches anything, it is that technological revolutions always reveal the assets that were underestimated at the start. In 2025, silver is that asset. The deadline is approaching, and those who recognize the shift early stand to benefit the most. There are rare moments in financial history when an asset sits at the edge of a fundamental revaluation, and most people don't see it until it's too late. Silver is standing exactly at that edge right now. The signals are loud, the data is clear, and the urgency is real. We are heading toward a critical date where multiple forces will collide, and once they do, silver's price will not wait for retail investors to catch up. That is why this moment demands attention, conviction, and action. What makes the situation so compelling is that silver is not being driven by emotion or hype. It is being driven by hard, measurable trends that are accelerating simultaneously. The first and most powerful of these is industrial demand. Silver is the most conductive metal known to science, and in a world shifting aggressively toward electrification, that matters more than ever before. Solar panel manufacturing is consuming more silver each year, and the global transition toward clean energy is no longer a forecast, it is happening in real time. Nations are scaling renewable infrastructure at a pace that transforms silver from a precious metal into a strategic energy asset. Electric vehicles amplify this demand even further. Every EV uses significantly more silver than a traditional combustion vehicle. As adoption rises, so does the strain on the silver supply chain. Add to that the explosive growth of AI hardware, advanced computing, 5G networks, and next generation medical technology, all of which rely heavily on silver, and you begin to see a picture that few investors fully appreciate. This is not a temporary spike in usage. This is a structural shift that deepens with every innovation cycle. But here is where the urgency sharpens. Supply is not rising to meet this demand. Silver mining has been in a long-term decline, with ore grades falling and new discoveries becoming increasingly rare. Mines cannot scale production fast enough, and recycling contributes only a fraction of what is needed to support global consumption. This imbalance is widening every year, and the market is only beginning to understand the implications. When you combine accelerating industrial demand with stagnating supply, you get a pressure buildup that eventually forces a dramatic repricing event. Financial demand adds even more fuel to this dynamic. Investors seeking protection from currency volatility, geopolitical tension, and slowing global growth are turning back to precious metals. Silver often benefits more than gold during these cycles because of its smaller market size. A relatively modest influx of capital can trigger a disproportionately large price move. Silver-backed ETF are quietly removing massive quantities of physical metal from the market, locking it into long-term storage and reducing availability for industrial players who already face shortages. This is where the critical date becomes relevant. Markets can remain calm even as these structural pressures intensify underneath the surface. But once a catalyst hits, whether it's a central bank policy shift, a supply report revealing a deeper deficit, or an unexpected spike in energy demand, the market reacts swiftly. The price doesn't climb gradually, it leaps. Those who wait until the headlines break are already behind the curve. The window we are in right now is defined by hidden imbalance, a moment when the fundamentals justify a much higher valuation, yet the market hasn't fully priced it in. These are the moments that reward those who act based on data rather than consensus. Silver is approaching its critical point, and ignoring the signals will come at a cost. The surge that follows won't be subtle, and it won't unfold slowly. It will surprise the majority, as it always does when supply and demand collide with unstoppable force. Those who recognize this alignment early and position intelligently will capture the upside that others will only understand in hindsight. The silver market is approaching a moment that very few investors are prepared for. Beneath the surface, structural forces are building pressure that will eventually translate into a price shock, the kind that redefines how the world views this metal. And the reason the timing matters so much is simple. Once silver begins to reprice, it rarely does so slowly. It leaps. That is why buying before this date is not about speculation. It is about recognizing an inflection point before the rest of the market catches on. What makes silver so compelling right now is that its underlying fundamentals are diverging from its price in a way that cannot last much longer. Silver has long been dismissed as volatile, secondary, or overshadowed by gold. But in 2025, it has transformed into something much more consequential, a critical technological metal that the global economy cannot function without. That shift alone is enough to justify a much higher valuation, but the truth is even more powerful. Demand is accelerating at the same time supply is tightening. Start with the industrial side. The transition to renewable energy is happening faster than expected, and solar power is at the center of that momentum. Silver is irreplaceable in photovoltaic technology. Its conductivity is unmatched. As nations expand solar installations to hit aggressive climate targets, they are pulling silver out of global inventories at a record pace. This is not a temporary wave of demand, it's a long-term structural trend that deepens every year. But solar is only one pillar of this shift. Electric vehicles require significantly more silver than traditional vehicles. The diffusion of 5G technology, medical equipment, AI-driven devices, and high-performance computing, all of these sectors rely heavily on silver. Every technological upgrade, every advancement in electronics, every innovation that leans on conductivity pushes silver further into a supply-constrained future. This is the type of compounding industrial demand that markets often misprice until the evidence becomes undeniable. On the other side is the supply constraint, and this is where the shock becomes unavoidable. Silver mining output is not responding to the surge in demand. Production has been stagnating due to declining ore grades, operational challenges, and a lack of major new discoveries. Mines take years to bring online, and the current pipeline is nowhere near sufficient to meet the growth in consumption. Recycling adds a small buffer, but nowhere near enough to close the gap. What we are witnessing is a structural deficit that grows larger with each passing year. Then factor in the macroeconomic environment. As interest rate expectations shift, currencies weaken, and geopolitical tensions increase, investors seek safe haven assets. Historically, silver amplifies the price movements of gold during these cycles because of its smaller market size and higher sensitivity to capital flows. Even modest increases in investment demand can trigger outsized price responses. And with silver, backed ETF accumulating physical metal, a significant portion of supply is being locked away, further tightening the market. This brings us to the urgency of timing. Markets tend to ignore slow, building structural pressures until something triggers sudden recognition. It could be a major supply report, a policy shift, a spike in industrial consumption, or a breakout in ETF inflows. But once that catalyst hits, silver will not move gradually. It will adjust sharply, catching most investors completely unprepared. Right now, the market is misaligned. The fundamentals justify a much higher price, yet the broader financial world has not woken up to that reality. That gap, the difference between where silver is and where it should be, represents the opportunity. And that opportunity has a shelf life. Waiting means risking missing the revaluation. Acting before this date means positioning ahead of the shock. The data is there, the pressures are building, and the window to benefit from this divergence is narrowing every day.